Welcome to Iron Financial. We are here to help you forge a stronger portfolio, cut right through the market weakness, and ultimately build your wealth on a rock-solid foundation. I'm your lead analyst, and today's explainer is our definitive blueprint assessment of Lowe's following their recent Q1 earnings release. Look, we are putting on our hard hats today and digging deep into these numbers, because let's be honest, the market's reaction to this print has been chaotic, just completely all over the place. And as seasoned traders know, an earnings beat doesn't always equal green arrows in a volatile tape. Sometimes the algorithms and the reactionary sellers just take over the steering wheel, and that creates a massive disconnect between the actual stock price and the underlying business. So we're going to drill down into the whole shebang, the revenue, the debt load, the margins, these new strategic acquisitions, all of it, just to figure out exactly what is going on beneath the surface of this home improvement giant.
And I'm the market skeptic. I'm here representing you, the viewer. Because honestly, I need to know if this is real structural strength we're talking about, or if management is just slapping a fresh coat of paint over a crumbling foundation. So let's get right into it, because the broader market is clearly not buying what Lowe's is selling right now.
Look, lead analyst, you can talk about blueprints and fundamentals literally all you want, but the reality on the ground is incredibly ugly right now. Shares of Lowe's have returned a negative 13.1% over the past month, and meanwhile, the S&P 500 composite, it's up 3.3%. That is a massive, glaring divergence. We're looking at a post-earnings sell-off that has investors sprinting for the exits. So my question for you is incredibly simple. Is this stock just a classic value trap hiding behind top-line revenue growth? Are we witnessing the impending death of home improvement spending as the pandemic hangover finally catches up to the consumer? Because, when a company reports a so-called good quarter and the stock immediately plunges, that tells me the street sees a structural failure. Or maybe they know something incredibly damaging that retail investors are completely missing. Seriously, is this a trap?
Okay, first things first, you need to ignore the short-term noise and focus on that critical technical support at the $215 level. Yes, absolutely, the post-release weakness dragged the price momentarily below $215, but what was the immediate, violent market response? It was massive, sustained buying. This isn't just a random floor drawn on a chart with a crayon. This is a foundation that was poured during the COVID-19 market explosion back in 2020 and 2021. It represents the psychological baseline where institutional buyers, the heavy hitters with the incredibly deep pockets, they step in to accumulate shares. We saw an intraday rebound and the formation of a doji candle. For those watching, that's a classic technical sign of market indecision that often marks the abrupt end of a downtrend. So whether it's bottom seekers, value hunters, or just institutional income investors, the smart money aggressively stepped in exactly where the structural long-term support told them to. Let's bring in the heavy machinery and actually look at the core Q1 numbers, because this is where the actual load-bearing walls of the company are built. Revenue hit an impressive $23.1 billion. That represents a 10.3% year-over-year increase. Adjusted diluted EPS came in at $3.03, up from $2.92 last year. When you compare that $3.03 directly to the street's historical expectations, you see a company that is executing flawlessly on its bottom line. And look at this. Comparable store sales increased by 0.6%, marking their fourth consecutive quarter of positive comps. To put that into perspective for a second, February comps were actually down 1.4% due to severe winter storms, but then they accelerated to a positive 2.1% in March and a positive 0.5% in April. Weather deferrals don't just vanish into thin air. The demand doesn't evaporate. It is simply recognized in later months when the ground finally thaws and projects resume. This is structural integrity in action.
Okay, hold on. I'm going to interrupt you right there, because you can throw heavy machinery and top-line numbers all day long, but I am looking for the catch. Nobody dumps a blue-chip stock 13% just because they don't like the weather in February. Come on, what is the real story here?
The catch, if you want to call it that, is the incredibly hostile macro environment that Lowe's is currently trying to build in. We're looking at external headwinds squeezing the entire market, creating an environment that management explicitly expects to remain completely flat throughout 2026. The housing environment is currently paralyzed. We've got elevated interest rates, higher baseline costs, and incredibly sluggish housing turnover. Because people are financially locked into their current 3% or 4% mortgages, they just aren't moving. And because they aren't moving, there is very soft discretionary demand in the do-it-yourself or DIY segment. CFO Brendan Sink actually called out current operating cost headwinds from rising oil, transportation, and commodity-linked inputs, things like lumber and raw copper. It is a brutal environment for the entire homebuilder and retail sector right now, and these massive external pressures are temporarily suppressing their core DIY segment. Okay, well, now we are getting to the actual cracks in the armor. You are out here boasting about a 10.3% revenue jump, but look at what it is actually costing them to get that. Gross margin dropped 70 basis points year over year, coming in at a really weak 32.7%. And adjusted operating margin, that dropped 43 basis points down to 11.5%. If we drill down and compare that to their peak seasonal operating margin of 14.5% back in August 2025, it literally looks like they are bleeding cash at an alarming rate. You can't just grow revenue if it completely costs you your bottom line. To me, this looks exactly like a desperate company trying to buy top-line growth while structurally deteriorating on the inside. Actually, that margin bleed you are pointing out is not a foundational failure at all. It is the temporary, necessary friction of heavy lifting. Lowe's recently made massive strategic acquisitions, Foundation Building Materials, or FBM, and Artisan Design Group, ADG. That 70 basis point drop in gross margin, it's primarily driven by the dilutive impact of integrating these massive, complex new assets into the parent company. In fact, they took a $96 million pre-tax charge this quarter just from acquisition-related amortization. And get this, out of the $112 million year-over-year increase in inventory, a massive $500 million of total inventory is directly attributable to staging these recent acquisitions. That $500 million is not dead stock, just gathering dust on a shelf. It is intentional, highly strategic staging required to launch these new divisions. They are building a significantly larger structural footprint, and that takes upfront capital.
Let's drill down into the actual mechanics of how these specific acquisitions are going to repair those temporary margin cracks you're so worried about. The near-term integration is completely on track. What they are executing right now is extracting cost synergies from overlapping areas of spend. We're talking about massive, explicitly identified cost savings in core procurement categories like drywall, structural steel, and insulation. At the same time, commercial contracts are showing extreme resilience at FBM. By the second half of 2026, Lowe's will begin anniversarying these acquisitions, which will dramatically reduce that drag on reported margins. And they are currently unlocking massive commercial cross-selling opportunities. Just imagine a commercial contractor buying bulk drywall and steel through FBM, and now, seamlessly, they are also locked into sourcing high-end fixtures and finishes from the ADG portfolio directly through Lowe's. It's a closed loop.
Fine, I'll give you that. They bought some revenue through acquisitions, and it's hurting margins temporarily. I get the logic. But if the core DIY consumer is essentially dead right now, where is the actual organic growth coming from? Because if they have to rely entirely on buying other companies to keep the top line green, this whole architectural blueprint completely falls apart. The organic growth is coming straight from the pro segment and their digital infrastructure, and this brilliantly illustrates how they are ruthlessly taking market share away from their competitors. Online sales just surged an incredible 15.5%. They are rolling out free same-day delivery for loyalty program members. Management stated they expect the pro segment to heavily outperform DIY for the rest of the year. By leveraging these recent acquisitions and their pro extended aisle, which, by the way, essentially gives contractors an endless digital inventory without taking up a single square foot of physical warehouse space, Lowe's is aggressively expanding into new residential and commercial construction markets that were previously completely untapped by the company. They have a stable project backlog and massive, growing engagement from small and medium-sized businesses.
And we have to talk about the technological reinforcements supporting this explosive pro growth, specifically the Milo Virtual Assistant. Look, this isn't just a tech buzzword gimmick to throw in an earnings call. It is a massive, automated productivity lever. Milo is currently handling over 1 million customer inquiries every single month online. And internally, the Milo Companion app is answering 5 million associate questions. Furthermore, by accelerating productivity programs like Freight Flow 3.0, they are drastically improving in-stock availability and automating back-end operations. Freight Flow 3.0 is a massive logistics automation engine. It takes all the guesswork out of distribution. It dynamically routes heavy, bulky inventory straight to the store or directly to the job site, which drastically cuts down on holding costs. This allows their human associates to focus entirely on moving high-margin products and assisting pros rather than running around answering basic logistical questions. All right, expanding the pro segment and using AI logistics. That all sounds great on paper, but you can't just abandon the everyday retail consumer. You admitted earlier that the DIY market is incredibly soft because of macro headwinds and high rates. So how do they plan to fix that massive gap in their core business? If the housing market doesn't thaw out soon, are they just going to leave the DIY segment to rot on the vine?
Not at all. In fact, they are building a highly profitable moat around the customers they already have with the launch of Home Care Plus. This is a brand new subscription maintenance service that's completely exclusive to Milo's rewards members. What this brilliantly illustrates is a highly calculated strategy to generate recurring, predictable revenue from the DIY base. Retail earnings are notoriously cyclical, right? They live and die by the seasons and the weather. Well, recurring subscription revenue smooths out that cyclicality. They are creating longer-term, extremely sticky relationships with DIY customers, completely differentiating their loyalty platform from their main competitors. The logic is simple. When discretionary spending is weak, you lock in the absolute loyalty of the customers who actually are still spending cash.
Let's shift focus to the balance sheet for a second, because this is where I start getting really nervous about the foundation. You talked about the heavy lifting of the FBM and EDG acquisitions, but heavy lifting costs heavy debt. The balance sheet still reflects a high debt position from their aggressive share count reduction programs over the past few years. So in a higher for longer interest rate environment, are they fundamentally overleveraged? And they've paused buybacks, right? Because to me, that is a huge red flag for the stock price. The balance sheet is under strict authoritative control. Their explicitly stated target is to reduce leverage to a highly manageable 2.75x by mid-2027. In Q1 alone, Lowe's deployed $2.4 billion in cash to repay incoming bond maturities. Adjusted debt to EBITDA currently sits at 3.1x, and they ended the quarter with a very healthy $786 million in cash and cash equivalents. Now, yes, you're right, share buybacks are on pause right now. But let's be absolutely clear about that. It is a feature, not a bug. Paying down high-interest floating rate debt in a hostile macro environment yields a far better, far safer return on capital than repurchasing stock. Prioritizing debt reduction right now will dramatically improve shareholder leverage and pave the way for massive sustainable buybacks once those margins actually normalize.
And while you patiently wait for that debt load to come down and the macro environment to clear up, you are standing on the most solid foundation in all of retail, a 60-year track record of consecutive dividend hikes. Lowe's is an absolute dividend king, period. In Q1 alone, they paid out $674 million in cash dividends to shareholders. How can they comfortably afford that while simultaneously paying down $2.4 billion in debt? Because they generated a massive $2.8 billion in free cash flow this quarter. That is a fortress of cash. Their dividend payout ratio is currently sitting at under 40% of their annualized earnings forecast. And for those keeping track, an under 40% payout ratio means this dividend is incredibly secure. It is completely insulated even if earnings compress further in a worst-case recessionary scenario. You are literally getting paid a premium, ironclad yield just to wait out this temporary market weakness. Okay, lead analyst, we've reviewed the blueprints, we've walked the construction site, and we've analyzed the raw materials holding this whole company together. I need a rapid-fire, no-nonsense summary of this entire assessment. You have temporary margin compression, hostile macro headwinds, and paused buybacks pulling the stock down on one side. But on the other side, you have a 60-year dividend history, double-digit top-line growth, and massive pro market share gains. So I am going to force a call right here, right now. For the retail investors sitting at home watching their screen, is this stock a dangerous value trap, or is this a generational buying opportunity?
The institutional money has already made the call, and they are setting a massive forward valuation floor. The TKR mid-case model sets a price target of $346. That implies a staggering 57% upside from current beaten-down levels. And why is a 3.8% revenue compound annual growth rate reasonable in that model? Because it strips out the pandemic anomalies, and it assumes a normalized housing cycle as interest rates eventually stabilize, while forecasting a net income margin step up to 8.2% as those acquisition frictions we talked about fade away. Furthermore, MarketBeat tracks 35 professional analysts, and they maintain a strong 63% buy-side bias. If you are looking out over the next 5 to 10 years, forward earnings forecasts suggest this stock has the potential to rise by over 100%. The trailing 12-month institutional balance is greater than 2-to-1 in favor of the bulls. That means the smart money is aggressively buying exactly what retail is currently panic selling.
Which brings us to the final iron financial verdict. Despite the temporary margin friction from those heavy lifting acquisitions, Lowe's has a rock-solid, structurally sound foundation. They are successfully executing a total home strategy, they are ruthlessly grabbing market share in the commercial pro segment, and driving unparalleled digital and logistical growth. And they are doing all of this while carefully navigating one of the toughest housing markets in recent history. The back half of 2026 is where this stock will truly earn its valuation as the acquisition dilution fades and all those synergies are unlocked. So here's a final provocative thought for you. Wall Street is currently panicking over a 70 basis point short-term margin dip. Are you going to let their short-term myopia blind you to a dividend king that is actively building a modern monopoly in the pro and digital retail spaces? Our entire mission here at Iron Financial is to help you forge a stronger portfolio and cut through this exact type of market weakness. Keep your foundation strong, rely on the blueprints, and we will see you on the next assessment.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.